Today, a 0.5% cash rate rise drives another nail into New Zealand property falls. Hello again, it's Martin North from Digital Finance Analytics. Welcome to another post covering finance and property news with a distinctively Australian and indeed New Zealand outlook today. The New Zealand Reserve Bank's Monetary Policy Committee has dropped a 50 basis point rate hike today by lifting the official cash rate to 1.5% from 1%. That's the first time it's delivered an increase of that magnitude since the year 2000, its biggest hike in 22 years. So the question is, does the 50 basis point hike represent a stitch in time, or is it a nail in the coffin of the property market? The move actually wrong-footed 15 out of 20 economists who had expected a 0.25% adjustment, but investors had assigned a 70% probability to a 50 basis point hike, so they probably knew what was going on. The committee agreed that their policy path of least regret is to increase the OCR by more now rather than later to head off rising inflation expectations, the RBNZ said. It is appropriate to continue to tighten monetary conditions at pace. They said that this was the path of least regret, increase now more rather than later. And they said they'll remain focused on ensuring that current high consumer price inflation does not become embedded into longer-term inflation expectations. So they've raised the cash rate for 4 straight policy meetings, lifting it by now 125 basis points since last October, as inflation surged to a 32-year high. The risk, of course, is that the rapid rise in borrowing costs could stall the economy, or indeed the housing sector. House prices are already falling, and business and consumer confidence have slumped amid New Zealand's worst outbreak of the COVID-19 pandemic. The Reserve Bank of New Zealand's decision to accelerate its hiking cycle shows it's willing to move decisively to get a hand on surging inflation, said Ben Uddy, an economist at Capital Economics in Singapore. We expect it to hike the OCR to 3% by the end of this year. The New Zealand dollar jumps after the decision before giving up most of its gains. It bought 68.7 US cents early afternoon in Wellington, and bond yields fell on expectations the more aggressive rate tightening will tackle inflation. Today's decision was a rate review rather than a full monetary policy statement, meaning the bank did not publish any new forecasts and didn't run a press conference, so we only know what they wrote in their release. In its statement, the Reserve Bank said it remains comfortable with the forward track for cash rates that it published in February, indicating it sees no need to take rates higher than the 3.25% peak that it forecast for the end of 2023. However, it says it wants to get the OCR to a more neutral stance sooner, and it estimates a neutral level for the cash rates around 2%. The committee noted that the OCR is stimulatory at its current level. It said members noted that annual consumer price inflation is expected to peak around 7% in the first half of 2022. The risk of more persistent high inflation expectations has increased, and the Reserve Bank of New Zealand aims to keep inflation around the middle of a 1 to 3% target range. In fact, New Zealand is at the forefront of global policy tightening as central banks around the world respond to an inflation surge that's threatening to become entrenched. The Bank of Canada is expected to raise its key rate by 0.5 point to 1% later today, while the Bank of Korea may add to its 3 rate hikes on Thursday. And the US Federal Reserve began its tightening cycle last month, and its policymakers have signalled they could move in 0.5 point steps if needed. The Reserve Bank of Australia only this month opened the door to rate increases, with economists tipping its first rate hike perhaps in early June. So again, Australia is a laggard here. New Zealand's ultra-loose pandemic policy settings drove house prices to 30% higher last year, while the closed border caused a labour shortage that's seen unemployment plunge to 3.2%. That's a record low, and inflation accelerated to 5.9%. That's the fastest since 1990 and is forecast to quicken further. At the same time, the country's rampant Omicron outbreak is actually curbing household spending, and rising mortgage rates are pushing the housing market into retreat. Remember, of course, that the Reserve Bank earlier forecast a considerable slide in home prices going into reverse as interest rates are on the rise. So they have reinforced that downward trend, in my view. Consumer confidence has slumped to its weakest since 2004, and business sentiment is the lowest since the pandemic hit in early 2020. House prices fell 2.3% in the 3 months through to February, according to the Real Estate Institute, and heightened global economic uncertainty and inflation are dampening consumer confidence, the Reserve Bank said today. The rise in mortgage interest rates, amongst other factors, have acted to reduce mortgage demand and house prices. Russia's invasion of Ukraine is actually worsening inflation by driving up commodity prices, while also hurting confidence and dampening the economic outlook. A larger move now also provides more policy flexibility ahead in the light of the highly uncertain global economic environment, the Reserve Bank of New Zealand said. It's interesting that ASB's economists were backing a 25 basis point hike, but added in a recent note that if the Reserve Bank of New Zealand does hike by 50 basis points, then rates are likely to gap higher. And of course, this is the fourth consecutive interest rate hike by the Reserve Bank of New Zealand. The Kiwi Central Bank elevates its policy rates at its last 3 monthly policy announcements by 25 basis points. The inflation rate in New Zealand was last recorded at 5.9% for the fourth quarter. Next up will be the New Zealand Consumer Price Index, which will give us a greater read as to how things are travelling. But I'm pretty comfortable in saying that with this hike in interest rates now flowing through to higher mortgage rates, we will see more downside movement in property prices. And given that consumer confidence is so low and business confidence too, it may well be that falls accelerate over the next little while. Now, they in themselves won't put any great pressure to reduce inflation because, of course, the inflation metrics don't really include the cost of housing directly. So it will be very interesting to see how this plays out ahead. My scenario for New Zealand is that rates will continue to rise through to the end of the year, and I wouldn't be surprised to see a terminal rate of about 3% by that time. And 3% plus the margin would put mortgage rates at 5 to 7%, depending on exactly where people are placed. That's a huge lift up from where they were previously, enough to considerably dampen the housing market. And it's worth reflecting on modelling that was done by the Reserve Bank of Australia that said, well, if rates move 1%, then prices in the medium term would move by around 30%, which suggests to me that we could well see prices retrace their levels to below where they were before the Reserve Bank of New Zealand started cutting the cash rate all those months ago at the start of COVID. Which of course then begs the question, well, what about all those people who are sitting on very large mortgages when incomes are under pressure, with costs rising, and the risk of negative equity? And will that risk ultimately mean that the Reserve Bank of New Zealand has to turn turtle and not take rates higher? That for me is a very open question at the moment. But they have signalled their intent quite clearly, so we must expect home prices to fall, and fall considerably. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.